Alright, you already know what this video is going to be about because we have to talk about CPI. Okay, I'm going to be covering CPI. I cover this every single month whenever CPI comes out. I usually comes out with an expectation video. I'm going to be coming out with a summary video. Okay, so pretty clear cut. The numbers that we got month over month, 0.2% month over month. Core inflation up 0.2% month over month, with the year over year going up 3.2%. So I'm going to be going through the whole entire report, tell you kind of like my opinions around it, sort of thing. Okay, so let's go. First up, 0.2%, like I told you, 3.2% before seasonal adjustment. The most interesting one for this CPI that we have to talk about is that the index for shelter was by far the largest contributor to the monthly all item increase, accounting for over 90% of the increase. So why is this so important? Because the thing is that a lot of people do argue the fact that, yeah, inflation is basically there because right now all we have to wait for is for the shelter to basically go away. Because once shelter inflation goes away, inflation is effectively gone. Technically. Okay, so where we have to actually talk about how this actually works out. Okay, so for people who don't really understand why does shelter inflation works in such a different way, later on I'll show you actually how it actually have this kind of weird inflationary trend for housing prices. So just think of it this way. For example, if you're going to be renting a house, okay, let's just say you're renting out your own house at like say $2,000 a month, okay? For example, you're signing a tenancy agreement for a year. Okay, it's going to be $2,000 a month. You're going to be renting out your house. Let's just say you rented the house for a year, and then basically housing prices went up, mortgage rate went up, interest rate went up. You want to now increase your rental to, let's say, $2,300 per month, for example. So when you actually do that increase, you're actually increasing it by about 10%. Or even more than 10% actually. That's about like I think 11%-ish. Yeah, about 11%, 11.5% I believe. So when you increase by 11.5%, it's not going to immediately reflect on the next months of CPI saying that, rental just went up by 11%. That isn't how it usually works. Because the thing is that as you are increasing your prices, people are slowly increasing their prices as well, and they have to collate all these different data points, and then they have divided alongside all the years. So the thing is that how it actually happened is that effectively every single month you'll just see like a 0.4% increase, a 0.5% increase, a 0.8% increase, a 1% increase, and that sort of thing. So when people just slowly just get it in one whole entire year, you're going to have like 12%. So that's how they actually get to those numbers. Okay, so which is why we are saying that for shelter prices, it is a lagging indicator. So for us to really see shelter price go down, it does take a significant amount of time. At the very least, you would need at least a year, because that's when you actually see housing prices or actually rental prices go down, and where people want to refinance their properties or people want to re-sign their tenancy agreements and such. So that's where the lagging indicator usually comes in. Okay, so next up, we have to talk about, the core inflation actually went up by 0.2%. This kind of proves that inflation is really, really sticky. So this is the hardest part of the fight for inflation. Well, the second hardest part, I would think. Okay, the hardest part is for you to get out of the hyperinflationary trend, and we got out of it. Okay, 9%. Thankfully, we stopped at 9%. It didn't go all the way to like 100% or something stupid. Okay, we stopped at 9%. Afterwards, we managed to curb it downwards with a lot of help from the Federal Reserve. A lot of people at that time think that the Federal Reserve, whatever that they were doing, all the QT that they were doing, all the balance sheet balancing that they were doing, all of it were basically not helping it at all. But time will tell, and time did tell that it did help. Okay, so now that we found out that it did help, we're glad that, of course, we are not in the hyperinflated trend. However, now the next hardest thing is core inflation. Core inflation is going to be really, really sticky. Why is it so sticky? So I'm going to go through this just a little bit more. So the month before, we actually got a 3.0 increase year over year. And of course, you can see in this chart over here, you can see that basically this is a relatively healthy month, or a healthy year. But it's just that because with numbers like all this in this 0.5, in 0.5, you have your October, you got your January with relatively high numbers, but you do not have a single deflationary month. So with every inflationary month, you do not have any sort of deflationary month to help you balance it out, which is why inflation tend to be a little bit sticky. And something that you also have to take note over here is right here. Energy index decreased 12.5% for 12 months ending July. So what does that actually mean? It means that the energy prices has really been helping the inflation go down. Okay, it's really helping disinflation significantly. Okay, only for the big numbers. Whatever they're going to be looking on the Bloomberg terminal, or whatever you're going to be looking on your Wall Street Journal, your New York Times, it doesn't matter. Whenever they are talking about 3%, 4%, 5% year-over-year inflation, energy prices is the one that's really helping because they have decreased 12.5% for 12 months as it is year-over-year. So there's a huge deflationary pressure over at the energy prices side, but we are expecting to see energy prices come back up a little bit again. So that's where the small spike up of inflation is going to be a little bit more concerning. Okay, so but where it actually doesn't really make sense is because in core, you don't have to care about energy prices. You don't have to care about food. You don't have to care about energy prices. So because of that, you can see that core prices is still going through this very sticky inflationary environment. Okay, so over here, you can see food prices still going up by 0.2%. Again, we have not had a single month, not even a single month of a deflation for food prices so far. Food prices has constantly been going up. The most that we had was, I believe in May, we had a 0% inflation. Okay, so we only had inflationary trends for food prices, which is why it continuously goes up. We have not really seen it go down. Of course, if you were to take it year over year, you're looking at about 3.6%. Index for cereal bakery is at 7%. Meat, poultry declined, but everything else is kind of going up. The major grocery store group posts increase ranging from 1.3% to 5.4%. So, food prices is still continuously going upwards. So that's definitely going to be a little bit more concerning. Now, energy prices starting to rose by 0.1%. Again, of course, listening to a energy price basically going up by 0.1% does not really seem like an alarming number. But the thing is that we are also expecting from the street consensus as well that energy prices will be going up a little bit in this coming year, in the next 12 months, or even in the next 24 months. Of course, we're not expecting it to go all the way to whatever that we had back in 2021, but we do still have some level of expectation of oil prices going up a little bit. Okay, so over here you can see shelter prices increased 0.4% over the month. It's the same increase as in June, like I explained to you guys before. Okay, so core inflation went up by 0.2% in July. Again, pretty sticky. We're not really getting any level of deflation. There's only a lot of disinflation happening. We have yet to see any level of deflation happening to the core inflation. So that's going to be pretty important for us to look out for. Okay, now let's get into the numbers. It's going to be a pretty quick one simply because there's really nothing that interesting about it. But the only interesting thing that I really wanted to take note of is over here, which is shelter. So you can see that, okay, over here you can look at this column is basically the relative importance, okay? The relative importance, basically all items will add up to 100% effectively. So you can see shelter takes up 34, rent of primary residence takes up 7.5, owner equivalent rent of residence takes up to 25.5. Okay, and all of them are 0.4, 0.4, 0.5, which is why you can see that inflationary pressure is really coming from shelter most of the time. Of course, housing prices is going up. Of course, when housing prices go up and when mortgage rates go up, when interest rates go up, it comes with where the rental price would have to go up. And when the rental price goes up, it's the same thing. It's going to be that kind of cycle. Okay, and when that actually happened, that's why a lot of people are kind of like concerned about how this is going to be turning out if inflation is going to just go overboard. But of course, I do think that what Bill Ackman was talking about, how inflation might actually stay long term, more than 3% year over year. I think that might actually be happening because right now we're not really getting that big of an inflationary pressure and we are already at 3.2%. And let's just say that we have housing prices come down a little bit. having housing prices come down a little bit in this sort of month, what we'll be expecting is most likely going to be a 0% increase month over month. Even then, what you're going to be doing is you're just going to basically have one good month, and then when energy prices hits, it's going to be going back up. When food prices hit, it's going to go back up. And of course, with housing prices, chances are you're not going to just suddenly have a huge plummet in prices for housing either, because housing prices and rental prices, they're not going to just go down, because how inflation basically destroy communities or the economy is because when prices continuously go up, it's very hard for you to bring it back down. So for example, if you are a homeowner and you are renting out your house at, let's say, $2,000 a month, okay, and you are going to be raising it to $2,500 a month after a huge inflationary cycle. Okay, let's just say 2 years of a cycle, you wanted to refinance your house and your mortgage suddenly just jumped up by 2%, so you decided to increase your rental from $2,000 to $2,500. Okay, so let's just say now you're at $2,500, okay? And let's just say, hypothetically speaking, 3 years from there on out, inflation basically goes back to 2%, or long-term average is back to 2%. Do you think you will somehow think that, oh, you know what, I think I can actually bring my rental back down to $2,000? Chances are you might think about it, but if your tenants are not asking for it, you're not going to do anything about it, right? Because not a lot of homeowners is going to go out of their way to be like, yeah, you know what, maybe I would actually lower my rental my rental amount. A lot of time the tenant would have to try to negotiate with them and say, hey man, interest rates has been really going down recently. Do you think it's possible for us to actually negotiate for a lower payment? Chances are the house owner is going to say, yeah, it's still pretty hard because payment is still pretty high, interest rate is still pretty high. Because let's be honest, interest rates at this point, it's going to take about 2 years before they even start to even think about cutting. That means the interest rate is going to stay up high for a longer period of time. And when interest rate is staying at such a high level, the person who is owning the house, aka you, will not be like, okay, you know what, yeah, inflation is gone, let me just lower my my rental price. Because that doesn't make sense, because you're still paying a high level of mortgage. Just unless you refinance and somehow drop from a 4% interest rate down to like a 2% interest rate, then maybe, just maybe, you will be able to say something like, yeah, okay, you know what, I did have a little bit of a leeway, maybe I'll drop it down to 2,300, maybe, okay, but not all house owners will do so. And because of that, then effectively, housing prices will not really go to zero. And that's what's going to be happening. What's happening in the market is that we're just adding on prices, and we're not going to be taking them away. What we're going to be doing is adding a bunch of zeros afterwards. It means that, okay, you know what? We are going to stop increasing. We're not going to decrease, we're just going to stop increasing. And that's going to be the danger in this kind of thing, because right now we're basically experiencing the prices that we are expected to be getting in maybe 2028. But right now, it's 2023 and we're getting the prices as it is. So yeah, that's why inflation is kind of dangerous. But honestly speaking, after this report, I kind of think that CPI is starting to become less and less impactful. As much as the Federal Reserve wants to read into it, they want to read more about PC and such. I'm not saying that I'll not make more of these reports, because I do enjoy this sort of data sets. But I'm just saying, the level of importance in this CPI reports are starting to, just dimmer down a little bit. Okay, even in the market action, when it was out yesterday, market barely moved on those data set, because it's like, okay, 0.2%, okay, that's fine. Core went up 0.2%, okay, doesn't really matter. People they want to put this different correlation or this causation to this CPI data to the market. So when it's going up there, it's inflation. If it's going, it's inflation. So we're not very sure. The market is very, very confused, even though this is just a very, very boring inflation report. But yeah, that is what it is. Right? That's all I have for this video. Thank you so much for watching, and I'll see you guys in the next time.